employees, but oftentimes the objective of a plan is to benefit the owner or owners of the company, and that's where Eric comes in and his firm, in which they do just a fantastic job designing plans for companies, and we work together in terms of investments, employee communication, and of course plan design and all the good compliance work that comes with it. So with that, my good friend and one of the best TPAs in the business, Eric Peterson.
All right, thank you. All right, so today we're going to talk about retirement plans, but before we get started, you do get CE credit. For some reason we put 2 hours, so however you want to play with that.
It's an hour for technical.
There we go.
So I think the way you do this is you put your name on here, I sign it, and you hand this in to your, whoever you hand it into. Isn't that the way? That's what I'm told anyways.
More copies.
And we do need more copies. Somebody
I'll
was
get those.
going to get those. So, okay, there's that part. So we're going to talk about retirement plans. I work for a firm called Hicks Pension Services. And basically what my firm does is they write plan documents and get it approved by the government. That's the first thing. That's a requirement to have a plan. The second thing we do is we do all the filing, compliance, reporting that's needed in plans. And we're a fee-for-service business. So I represent Hicks Pension Services. I've been doing it for 25 years. In my career, I've set up about 5,000 plans. And so when I am speaking to a group of CPAs, I want to first of all invite you all to ask questions as we go along. But I also try to give you insight as to what your clients are saying. You typically will ask me to go see somebody and explain how a plan works, and they come to this from a little different mindset than we all do. They have questions that they don't surprise me anymore because I hear them all the time, but I'm going to try to share a lot of that with you here today, okay? First, and that is off. All right, so we need a password.
Oh.
I knew that would time out. Okay. So, I'm going to have to pull out.
Hey, Rich, we need a password to type out.
And if you want, you can help with advancing it. Just let us know if you want me to help with advancing it.
So the first question always is, wait, I'm skipping ahead. So as far as, doing the Form 5500 and all the filing, you know what I hear sometimes from clients when they're not doing it is they say, oh, my CPA does that. So do any of you file Form 5500s for your clients? Maybe one or two on a very rare occasion? For yourself. It's surprising to me that clients think that you do that. And I already know you don't. When they say that, oh, my CPA does that, I already know you aren't doing that. It's not part of the agreement, but that comes up. So the other thing that comes up is who can sponsor a qualified plan?
There you go.
Any type of entity can sponsor a plan. That's something else that surprises me that plan sponsors, say business owners, sole proprietors in particular. I'll go meet with them and they'll say, I thought I had to be incorporated to have a plan. So as you all know, we don't have to be. And one thing that's nice is all the rules are essentially the same depending on the type of entity. From one plan to the other, there's not much of a difference. Unless we're talking about a non-profit. They have different types of plans that they're allowed to do, and those have rules that are surprisingly different from what for-profit plans have, 401k type plans. And the advice that they're getting out there is so jumbled, it's surprising to me that they don't really have an idea. I hear all kinds of stuff.
Yeah. Finally got your laptop on.
All right. So the types of plans. Before I get into the types of plans, before I get into that, I try to stay away from the names of these plans. To me, a retirement plan basically is a tax deduction. That's what it is. And depending on how big of a tax deduction you want and how many of those dollars you want tax deferred, then we will give it a name. A basic plan that you're all probably familiar with is called a SEP, Simplified Employee Pension. That's where they put how much percent of their pay? Like 25% of their pay, and that's the max, and that's their plan. If that works, and they don't have employees that they have to cover, if that plan works, that's their plan. Then we will give it a name. These plans have all kinds of different names, but again, I try to stay away from that, and I try to just make it such that these are tax deductions. Okay, that's what the plan is. So, I get to...
New technology.
Yes.
So now I'm going to press buttons.
Yep. You can just space bar and it'll pop you. And directional keys will take you.
Up and down.
Okay, so gone over who the sponsor is. This is a presentation I do in front of plan sponsors, kind of show them how a plan works. So plan sponsor, we've gone over that any type of organization can be a sponsor. And the next question they usually have is, where does all the money go? All the money in all these plans goes into what we call a tax-exempt trust. And when you have a trust, you need a trustee. And the responsibility of this trustee is to make investments available to everybody. We do that through the folks here in this room, number one. And number two, money can't come out of a plan unless a trustee signs off. So typically, who is the trustee? Is typically the business owner, so that they have control of what's going on within their program. And it also provides an extra layer of security for our retirement. Nobody's touching my retirement unless I sign off. I mean, that's what we need to have. So I press space, I guess.
Or the arrow.
Arrow down. There you go.
Now this trust does a couple things for us. The first thing it does for us is it gives us a tax deferral, and I'm going to come back to that in a little bit. The second thing it does for us is that it gives us a certain degree of safety. Money that's held within these retirement plans is not attachable to our creditors. So, you know, people can go and sue our companies, they can sue us as individuals, they can get our houses, our cars, but they cannot touch our retirement plan because it's held separately in the trust. Now, we all learned how that worked if we watched the O.J. Simpson trial years ago. I guess he just got out, but when he lost that civil trial, the Goldmans got all his money, but they could not touch his NFL pension because it was held separately. So we have that same protection here. We just won't need it like he did, right? The money in these plans is also what we call self-directed. And what I mean by that is each participant has their own account and makes their own investment decisions. Now, there's a reason that we do that in retirement plans. First and foremost, we don't want to make decisions for our employees. It's their money. We don't want to do that. Secondly, we don't want the liability attached to that. So we discharge that liability. We get rid of it if we do a couple things. Number one, allow them to have choice. So we do that through Emeritus, we do that through Thrive. Number two, we provide education. If we do those two things, we as a plan sponsor have relief from that fiduciary liability, as long as you take all the steps that we need to take to make those two things happen. That's why we have self-directed accounts in these 401k plans. If you ever do any reading on 401ks, you will probably see that most of the discussion is about this investment portion. It's about how to properly educate. That is an important part of the plan, and that is part of the package. But being a number cruncher and a 400 section of the code geek like me, I'm much more interested in how do we operate the plan. What does the code allow us to give to our plan sponsors, and how much do we have to give to our employees? So that's the part that I always focus on first. Back to tax deferred. Your clients say this to me, yeah, but I get the tax savings state. Don't I have to pay when I pull it out? Do you ever hear that? Mm-hmm. So when we are talking about a 401k plan, we are talking about a tax deferral. And if they don't understand the benefit of having that tax deferral, they're not going to like the plan so much. I do have lots of clients that tell me, though, my CPA told me to do it, so I'm doing it. They don't even understand the tax deferral, they just did it because you told them it's a good idea. So I like to explain that idea to them a little bit. When I do that is I use this example. This is what we call in my business a mountain shot. So this is how this works. Let's say that we had $10,000 a year that we wanted to invest. If we were just going to take that as earned income, we don't get to put in that full $10,000. The government's going to take some, right? Mm-hmm. About 40% is the number I use, and the earnings I'm going to use is 8%. I guess last year the market did 20, but I'm using 8. Okay. If we did that for 30 years, 10 grand, we don't get to put in 10, we only get to put in 6 grand. We earn 8% interest, but we don't get to have all that earnings. The government takes from our earnings in a bank account, right? Mm-hmm. So that ends up being about 400 grand. Now, if we do that in a retirement plan, we get the full 10,000 going in. And we get the benefit of that 8% interest, that compound. There's no tax taken out, it's all deferred. So if we do that for 30 years, we're at 1.2. So now the client's question, yeah, but don't I have to pull the money, pay it when I pull it out? Well, first of all, you have 3 times as much. But let's look at what happens when we pull the money out. And that's our next slide. So let's take the money out of the bank account. Let's take out 60 grand a year. If we do that, our money dries up in 8 years. That's your retirement plan, then what do? We go back to work, right? We don't have any more money, okay? But now let's pull it out of the retirement plan. And let's not pull out 60 grand a year, because we want to compare this apples to apples. Let's pull out $100,000 a year, pay 40 grand in taxes, and then see how long this money lasts. And if you can see in my chart, over a course of 20 years, we have not even spent half of the principal. Now there's a reason for that, and I made this chart years ago before Excel could do it for us. You know, I did this by hand, charted out, and what you learn real quickly when you do it by hand is that I'm still earning that 8% interest. So I might take out 100 grand, but I'm replacing it with about $90,000 of interest. So, you know, that's why it doesn't go away. Once I show them this, they start to say, oh yeah, now I get why my CPA told me that tax deferral is a good thing. Okay? There's one other point that gets missed, and I pull out this other chart, and I show them that, hey, we have a marginal tax rate system. So right now we're earning this in the max. So one of your clients that makes $300,000, every dollar they make above the $300,000 is taxed at what, 50% or is it 49? What, is that a fair number? 48 or whatever? Somewhere there. But in retirement, if this is our retirement income, the first 100 grand we pull out is earned income, but that's not taxed at that full rate. So we're taking advantage of the marginal tax rate system and pulling it out at a lower rate. Even if we think rates are going to go up, we're still way ahead. So once I show them that, they say, oh yeah, tax deferral is the way to go.
Hey, Eric, would this account for why some people may move to tax-friendlier states like, say, Florida and Washington and Nevada?
Oregon.
I mean, that's a strategy. I mean, we're Californians, we love it here, right?
We don't care what it costs.
Are we going to move to a tax-free state? There's what, Florida, income tax. Oregon, I think, is income tax, right?
No, Washington.
Nevada?
Washington.
That's an option. But, you know, I'm 55 years old, so I'm thinking about retirement. I know it's a long ways away, but I'm already preparing. So I've looked at that play. Go there, go to Oregon. Yeah, but there's a sales tax of 11%. The property tax is huge. So it's like, you don't have one, you don't have any, but they get it in other ways. If you add them all up, they're all about the same. But anyways, that's on the moving strategy. That's just from somebody looking into it. Well, I still have ways to go. So let's talk about, so that was the tax deferral. So now let's talk about how we receive those tax deferrals, how the plan operates. So this is part of a presentation I do in front of your clients. I do it on a yellow pad. It's better be somewhere over there. I put it someplace. It's right there.
Yep.
And I just circle it out and start explaining how the plan goes. They usually ask me questions as we go along, okay? So feel free to ask as we go along. Okay. So how does the money go in? It goes 2 ways. Either the employee puts it in or the employer puts it in. When the employee puts the money in, that's a what, a 401k? There's a limit on the amount the government lets us all do. How much is that? So the limit is $18,500. This is last year's numbers. I haven't updated this. It's only January, okay? And then if you happen to be 50 or over, you get to do what's called the catch-up, and you get to do $6,000. The only way that salary deferral can go into the plan is off of your W-2. There's no other way, unless you're a sole proprietor off your earned income, okay? But let me get away with saying W-2. Oftentimes, I hear your clients say, well, can't I just take this money out on the side and throw it in there? No, it can only come from a W-2. You can roll money in, and that doesn't affect these numbers per year, but that's the limit. Now, one would think the government gave us that limit, that's how it works. That's how much we get to put in, so everybody do what they'd like. And they made it more confusing in retirement plans. Other countries that have employee contributory plans don't have this, what they call the non-discrimination test, otherwise known as the average deferral percentage test. Other countries don't have that. Canada doesn't have that. We have it. We have it though. And here's how it works. And this is the whole part of testing. So if you want to know about testing, all you have to do is pay attention for a couple minutes, all right? All right. So what we are required to do is take our company and split it into two groups. One's called the highly compensated, the other's called the non-highly compensated. Our definition of a highly compensated employee is somebody who makes more than $120,000 a year. So before we tell those folks what they are allowed to put into the plan, we have to figure out what everybody else puts into the plan as a percentage of their pay. Some will do 10% of pay. Some will do 5%. Some won't do the plan. So what we have to do is take the average of these percentages. In this example, that works out to what?
5?
Thank you. You're not supposed to answer, Barry.
I was killing Randy. I was
You all-
thinking of you.
You all knew that math pretty quick, right? All right. So 5%. That's a 5. Let's see, the screen's not done. So that's the average of what the plan participants, the non-highly compensated employees, put in. So we take that number and we go over to our highly compensated and tell them that's what you are allowed to put in as a percentage of your pay, plus 2. You get a little bump. So that works out to 7%. So what do most of our employers say when you tell them they're limited to 7%?
No way.
Oh, I want more, right? So, what can we do to get a little bit more? So the one thing that we can do is have eligibility requirements, and really the main reason to exclude anybody from the plan, that's what an eligibility requirement does, is to get rid of the zeros in these numbers. So we can say that you have to be 21, you have to be full-time, 1 year, you have to be here on the last day of the plan year. Certain classifications of employees we can just carve out. Like this company has the advisory team. They also have the manager. We can just say the manager's not in. Carve them out. He wouldn't like that, but we're allowed to do that. Right?
Cut me out my own plan, Eric.
Well, we don't want to cut them out. All right, so we're allowed to do that. I want to define these a little bit more full-time. Does anybody know the definition of a full-time employee?
40 hours a week.
1,000 a year.
I've heard 1,000, I heard 30, I heard 20. The definition for pensions, for 401ks is different than everything else. Health plans have a different definition. In 401ks, it's 1,000 hours a year. So that's 20 hours a week. So that's something plan sponsors never get. They don't. So I have to go over that. That's when we spend some time on. I've been here a year. Classification, if we're going to use that rule, has to be a non-discriminatory classification. We can't just pick out managers. I mean, we could pick out managers, but we can't just pick out based on age or other factors that aren't quantifiable like that. So again, the only reason we have these eligibility requirements is to cross out some of those zeros. So maybe by employing those eligibility requirements, we get to cross out a couple, and now our average is what? 7.5%. We can tell our employer 9.5%. They come back and what do they say to us?
More.
They want more. I just skipped one thing. This is non-discrimination testing, also called the average deferral percentage test. This is it. This is nothing more complicated. But I do want to say it does get more complicated in that how do we fix a failed test? There's really two ways. One is to give these highly compensated people a refund. Take their money out. You've all seen that happen to your clients, right? They get this refund. That's why. There is another solution, and I can tell you not every third-party administrator works the same. Some don't offer this idea. The other idea is to just give these folks a little bit more money. Have the company make a contribution for them, and if that number is small, and these highly compensated folks can still maintain their big deferral, it's a great idea. That should at least be presented to your clients when they are facing a failed test. I'm also going to say that there's more than one way to do a test. There's more than one way to define who is a highly compensated employee. So if your clients come to you and say, we have a failed test, this plan is no good, it's broken, let us at least take a look at it, because there may be other ways to run the test. Other service providers